everyone. My name is Adam Sweet. I'm a principal with Eide Bailly in Spokane. I sit in Spokane, but I'm part of our national tax office, and my focus is pass-through entities, S corps and partnerships, and I'm part of a group at Eide Bailly that's been focused on opportunity zones. And another member of our group here is Max Stevens. Max sits in our billings office and consults with our national tax practice, and he's been also following along the Opportunity Zone program. So appreciate everyone attending today, and hopefully we can make this an informative hour. So just the real basics, I'm sure everyone's aware of this, but Opportunity Zone basics, they were created as part of the Tax Cuts and Jobs Act of 2017, so part of tax reform. Tax reform was passed in December of 2017. The Opportunity Zone program, it's really a combination of state and local governments working with the federal government. So obviously tax reform is what the federal government created the Opportunity Zone program, but the designation of Opportunity Zone areas was done working with state and local governments. And the focus was on quote unquote, areas in need of investment or certain low income areas. It was based off of the census tracts from 2010. So state and local governments nominated certain areas and said, these are the areas that we think are worthy of the investment. Those went back to Washington, D.C., and there was some back and forth. And then ultimately that was how these areas became designated. If you're curious about your particular area where the opportunity zones are in your area, we'd encourage you to look at our website with a link there at eidbailly.com/opportunity. We have a listing of our insights that we've published on opportunity zones, as well as a link to the various maps. I'd also put a quick plug there. Our Opportunity Zone working group is led by a partner in Fort Collins, Colorado. His name is Joe Monty, and you would see his contact information if you go to the website there. And so please do reach out to him or reach out to us if you need help with anything in relation to opportunity zones. Generally, backing up to the opportunity zones, generally they're effective for the 2018 tax year forward, and you can have up until 2027 to realize the benefits. And generally speaking, to realize the benefits, you need to make your investment within 180 days of a sale, which we'll cover in a second here. We do have final regulations. They were issued in December of 2019, so only about 2-3 months ago. And today's discussion will really largely focus on those final regulations. The final regulations are generally effective 60 days after they were published in the Federal Register. So they're published January 13th of 2020. So they'll be effective, I guess, as of March 2020. But fortunately, you can rely upon, even though they're not effective yet, you can choose to rely upon the final regulations, or you can choose to rely upon the proposed regulations. And we have more on this in a second. So just the basics first. The basic thought is that if you have eligible capital gains, and that's generally speaking, that's you've sold a capital asset to an unrelated party, you can choose to defer some or all of that eligible gain by investing that gain into a qualified opportunity fund, a QOF. Generally speaking, you have 180 days from the date of sale to invest those gains into the QOF. Now, a couple of important points there. Right away, you see that you can't actually take your gain and just buy property directly, unfortunately. That you need to actually set up an entity, invest gain into the entity, which is the qualified opportunity fund, and then the fund is the one that makes the investment or makes the purchase. Why? That's just the way the statute was set up. That's the way the rules were set up by Congress. Maybe not the most elegant solution, but that's what we have. Why would you do this? Well, or what are the tax benefits for why you would do this? Well, the first thing you would get is if you have gain from the sale from an unrelated party, if you invest gain into an opportunity zone fund, you can defer that gain, meaning you don't pay any tax on that gain. So I have a simple example here. Taxpayer realizes $1 million of eligible gain in 2020 and chooses to invest all of that gain into a QOF, into a qualified fund. And then 10 years later, in 2030, taxpayer sells the QOF interest for $2 million. And importantly, like all of our examples, and really importantly for all purposes of this presentation, let's assume that all other relevant requirements are met. What happens? Well, the first thing in 2020, the taxpayer gets gain deferral, so that when they file their 2020 tax return in 2021, they will not pay a single dollar of tax based on that $1 million of eligible gain. Importantly, the word is deferral. It's not permanent, it's deferral, and we'll get to that point in a second. If they held their investment for 5 years, so in my example, if the investment was made in 2020, they've held their investment in 2025, taxpayer receives a free 10% basis step up. Just only because the taxpayer held it for 5 years, they get this free step up. They had a $0 of tax basis in 2020 because they deferred, they didn't pay any tax on the gain. So their basis in the interest in 2025 would suddenly be $100,000 created out of thin air. So a very taxpayer friendly rule. 2026, the point I made about the deferral not being permanent, 2026, the gain is recognized. The remaining gain is recognized in 2026. So in my example, this would be $900,000 of gain. $1 million was deferred. We received a $100,000 free step up. So there's $900,000 of gain. And also importantly, it's taxed at 2026 capital gains rates. So if rates go up between now and then, you may be potentially worse off using those rates in 2026. The real juice in the program, for lack of a better word, is if you hold your interest for 10 years or longer, and then you sell your interest, or if the fund sells its assets, you can exclude all of the gain, all of the appreciation on your investment. So in my example here, if they sell it for $2 million, so their investment's doubled in value, that $1 million of appreciation is, if all other requirements are met, the taxpayer can realize that without recognizing any tax gain. And that includes any depreciation recapture, really any capital or ordinary gain other than gain if there's any inventory assets. We'll discuss that later. But generally speaking, all gain that would ordinarily be recognized is not recognized if you've held your investment for 10 years. So that's the real power of the program. The deferral is nice, the step up is nice, but it's the 10-year hold and exiting at the 10-year mark without paying any tax on the appreciation. I think for most people, that is the sales point, or that is the selling point of the program. So it brings us to our first polling question. Are you considering an investment in a QOF, in a qualified opportunity fund? Interested. I think that's probably similar. I think still it's similar to a lot of our clients, that there's a lot of interest out there about the program, but I think a lot of people still maybe are not quite sure. They may have gains, but perhaps they're not quite sure yet whether they're going to participate in the program. So with that, I'll turn it over to Max Stevens to take us through the next section.
Thanks, Adam. Good morning and afternoon to everyone, and thanks for joining us today. First, I'd like to take a couple of minutes just sort of setting the stage for some of the key terms involved when looking at an investment in an opportunity zone. As Adam mentioned, the Qualified Opportunity Fund, or out of habit, I may refer to it as a QOF or simply the fund. But this entity that set up the fund is really the gateway to unlocking the opportunity zone incentives. So, and as Adam walked us through, if you want to defer eligible gain, you have to invest the gain amount into a QOF within 180 days of sale. A QOF can be an LLC, a partnership, a C corporation, an S corporation. The structure is pretty flexible, and it can vary depending on the nature of the business that you're going to operate within the zone. Interestingly, there's no pre-approval process with the IRS. It's not like setting up a tax-exempt organization. Basically, the QOF self-certifies itself and monitors its compliance with this 90% assets test that we'll talk about. That sounds pretty easy, but it puts a burden on taxpayers to do it right from the start. And the 90% test is done at 6-month intervals to determine whether at least 90% of the fund's assets consist of what we call good Qualified Opportunity Zone property, or QOZ property. The results of the 90% asset tests are reported annually in the fund's tax return. Taxpayers can certainly invest other money or property into a QOF, not just the eligible gain amounts. And doing that results in what are called mixed investments that don't qualify for any of the incentives. So, this can be like any other business. You can put money or property into the fund that isn't from an eligible gain, but those won't qualify. Those investments will be treated just in the normal fashion. No special treatment, no incentives. There's no restriction on the ability of a fund to use debt to purchase property or to fund operations. So in a lot of cases, I think investing in a fund can be an interesting alternative to a Section 1031 like kind of exchange. Not to go too deep into this, but only the gain amount realized needs to be invested in a fund instead of investing the entire proceeds like you have to do for a 1031 exchange. And the gain can be deferred on the sales of property of things other than real estate. So you can have, deferred gain from the sale of stock. And of course, as Adam mentioned, the deferred gain amount, or at least the bulk of it, has a limited deferral to 2026. That's where a 1031 exchange has an advantage, since gain there is deferred until the new property is sold. So you have more control over that deferral. And maybe if you hang on to the property till you die, get that tax free. Next, I wanted to take a look at some of the other key terms. In order to meet the test for holding 90% of its assets in good QOZ property, a fund has to conduct its business in an opportunity zone either directly by purchasing QOZ business property or indirectly by holding shares of stock or a partnership interest in a subsidiary type entity that itself owns the QOZ business property. The QOZ stock, if it's a corporation, or partnership interest, if it's obviously a partnership, has to be acquired after 2017. QOZ business property is generally tangible property that's purchased after 2017 from an unrelated party. And it either needs to have its original use in the zone or be substantially improved. And Adam will get into more of those details here in a bit. So what's a QOZ business, or a qualified opportunity zone business? We use the initials QOZB on this slide, I guess. Well, when the QOF uses a subsidiary to conduct a business in the zone, the subsidiary has to meet the definition of being a QOZ business. This lets the subsidiary stock or the partnership interest qualify as good QOZ property in the hands of the fund for purposes of meeting its 90% asset test. So to be a QOZ business, at least 70% of the tangible property owned or leased by the business must meet the definition of QOZ business property. And this is one of the advantages of using the subsidiary QOZ business. It has a 70% test rather than the 90% test for a fund. At least 50% of the gross income has to be from the conduct of a trade or business in the zone. A substantial portion, and they pegged this at a 40% threshold in the regulations, of any intangible property must be used in the business. The final regulations added some general comments on what it takes for intangibles to be good QOZ property, but it's still kind of a fuzzy concept to me, and an area where we'll need to focus on a case-by-case basis. It involves things like, by intangibles, we're talking about things like intellectual property, patents, copyrights, trademarks, and having to decide whether, well, are those located in the zone and used in the zone or not? So that's where there'll be some interesting discussions. Continuing on with the QOZ business requirements, it has to hold less than 5% of its assets in what's called non-qualified financial property. It's basically debt, stock, partnership interests, other types of investment assets. There's an exclusion for working capital that, again, Adam will take us through later. This basically means, in my mind, you probably can't start a bank in a zone and get the tax incentives. The QOZ business activity can't be disqualified, or what are referred to as SIN, S-I-N types of businesses that are listed on the slide, and it can't lease property to a tenant operating those kinds of businesses. And the final regulations fortunately give us a de minimis rule telling us that a small amount of sin in the business or by a tenant is okay. An important point, the restriction on sin businesses only applies to the QOZ businesses, the entities at the subsidiary level. There's no problem with an operating fund, opportunity fund itself carrying on a sin business directly. So questions we've heard kicked around are things like, would a spa be a massage parlor? Or is a winery or a distillery a liquor store? And there may be no clear answer depending on the facts. So operating that type of a business directly through an opportunity fund may make a lot of sense in some cases. Next, might have a few comments on eligible gains and 180-day reinvestment requirement. There was a change in the final regs to the 180-day window for eligible gain that's passed through a partnership or an S corporation. Partnerships and S corporations are eligible taxpayers, and they can elect to defer eligible gains. And as a rule, they have the usual 180 days from the date of sale to reinvest the gain into a fund. But if the entity doesn't elect to reinvest and defer that gain's then allocated to the owners, the partners or the shareholders, and they can elect to defer their shares of the gain during the 180-day period that begins with the last day of the entity's tax year. And then the proposed regulations also allow the owner to use the same 180-day window of the entity based on the date of sale, so that's another option. And then the final regulations add one more option, as if we didn't have enough. Under this new option, the owner, the partner, or the S shareholder can elect to start the 180-day window for reinvestment on the due date of the entity's tax returns, and that's determined without taking into account extensions. And then there's similar rules that apply to certain trusts and estates. But this might be worth an example. Say we have a partnership that uses a calendar year end, and it sells a capital asset to an unrelated party on March 1st of 2020, resulting in an eligible gain. Well, here are the choices under the final regulations. The partnership kind of gets first dibs, and it can elect to defer the gain by reinvesting the gain within 180 days of March 1st. But if the partnership doesn't do it, and it may not, if some of the partners want to defer and others don't, the partnership may not do it, and then the partners can elect to defer their shares of gain and start their own 180-day clock for reinvestment on one of three dates. They can use March 1st of 2020, the date of sale, or December 31st of 2020, the last day of the partnership's tax year, or wait to start the clock until as late as March 15th of 2021, the due date of the partnership's tax return. And so this last option could benefit those owners who don't have a clue what their gains are until they get their K1 for the year. Moving on, installment sale gains is kind of interesting. I think we're on slide 21. Yeah. The final regulations make it clear that if you sell an asset on the installment method, you can elect to defer some or all of each and every gain amount recognized as the payments are received, at least until through the end of 2026. And this is the case even if the initial sale that gives rise to the payments took place prior to 2018. The 180-day clock for reinvestment can begin either as of each payment, when each payment's received, or you can wait and start the clock at the on the last day of the tax year. There's an example on the slide that kind of walks through that. I think the key point in my mind is that using that last day of the tax year could be appealing if you receive, say, 12 monthly installment payments during the year. So instead of having 12 separate 180-day windows, there'd be only one if you chose to wait till the end of the year to start the clock. I'd like to spend just a couple minutes on Section 1231 gains. The treatment of Section 1231 gains has certainly been an area of some confusion since the enactment of the statute. Maybe first take a little step back. Gains and losses that are realized from the sale of property that are used in a business, typically we're talking land, buildings, equipment, that's been held for longer than 1 year are not capital in nature. They fall into this special category called Section 1231 gains or losses. And then when these 1231 assets are sold, there's a netting process that goes on. And if there's net Section 1231 gains for a year, they're taxed as long-term capital gains. But if there's net Section 1231 losses, they're deducted as ordinary loss. That's kind of the best of both worlds. But because of this netting rule, the proposed regulations required the netting to be done before starting the 180-day reinvestment period for any net Section 1231 gain. So a quick example, Adam has $500 of Section 1231 gains, say in January, and a $300 Section 1231 loss in December. Well, he has to wait till December 31st to start his reinvestment period, and his gain eligible for reinvesting in an opportunity fund is only $200. That's the net amount. And even if he had no loss in December, he'd still have to wait till December 31st to start the clock for reinvesting his $500 of net Section 1231 gain for the year. And again, that's how the proposed regulations work. The government, I think, was fairly generous in the final regulations, and they allow taxpayers to defer gross Section 1231 gains, just like any other eligible gains. So in our example, Adam's 180-day clock for his $500 Section 1231 gain begins on the date of sale in January, and that amount, the $500, can be reinvested in an opportunity fund, even if he incurs Section 1231 losses later in the year, and even if those losses are greater than his gain amount. And that takes us to our next polling question. Do you expect to realize eligible gain during 2020? And you've got yes, no, or not sure. Okay, that's interesting result. At least we've got not a third of the folks that or more that may have some gains. Adam, I think we go to you now. Right?
Thank you, Mac. So I think Mac gave a very nice overview of what is qualified property and maybe what is not qualified property, but kind of along with it, that question or that issue is how do you acquire the property? And interestingly, it's not as necessarily straightforward as people would assume. I think I mentioned in the beginning, we've had more than a few people call us and very excited that they've acquired property in an opportunity zone. And then you quickly find out that perhaps the way they acquired it or the property that they acquired doesn't meet the rules, even though it is in an opportunity zone. Either they didn't buy it through a fund, or as we're going to get into in a second here, they're not going to be able to satisfy the various requirements. So I think it's important, even if you have gains and you're looking at a piece of property or looking at a business in an opportunity zone, and it makes economic sense to do it, I think it's really important to take a step back and talk with your tax advisor and say, okay, we know what we want to do, but let's be very careful about how we do it so that we don't, unintentionally footfall on anything and suddenly end up with bad property, or even worse, jeopardize the deferred gain. So the first category of kind of quote unquote good property or acquiring property is tangible property. And there's two ways that you can acquire tangible property. Or have good tangible property, and I'll cover both. The first is you need to be the original user, or the tangible property needs to satisfy the original use requirement for purposes of opportunity zones. And the first step there is that you need to purchase it from an unrelated seller, and you need to purchase it after December 31st, 2017. So if you acquired property back in 2016 and it's in an opportunity zone, that property is not good property for opportunity zone purposes. And this has come up again more than a few times, where we've had a client or we've had someone call us very excited saying, hey, I bought a building, I own a piece of land, but I bought it back in 2015 or 16. And that's not good property because it was not purchased post 12/31/2017. The second point I'd make is the unrelated seller. We're not going to get too down into the details on this, but there's a very stiff related party rule for opportunity zone purposes. And all that it requires is if there's more than 20% relatedness, then you're considered related for purposes of the opportunity zones, and you can have disqualified property. Very stiff, because in other contexts, usually the standard is 50% or more. And so there's much lower standard. So anytime, if there's any amount of relatedness or cross ownership and you're buying and selling property, you want to take a step back and think about that. A couple of new rules, or maybe new clarifications in the final regulations. The first is, there was some question, I think, that if you bought land or you started a business in an opportunity zone and you're making something, you're manufacturing something, or you're constructing something, or you're producing something, does that satisfy the original use? And you think about it, the reason why that question arises is that you don't just start on day one and suddenly have the completed property. There's a whole process that goes into that may take a couple of years. And indeed, the IRS confirms, yes, that will satisfy the original use requirement if you're manufacturing something, constructing something, as long as the process in doing so started after 12/31/17, and your acquisition date, for opportunity zone purposes, is when, quote unquote, the date when physical work of a significant nature begins, quote unquote, whatever that means. But I think that's just clarification. I think a lot of people probably assumed this was the rule anyways, but it's nice to have clarification on how that works. Otherwise, original use generally begins when property is first placed into service. Placed into service is a tax term, and generally it's the person who's first takes depreciation on property, or is able to take depreciation, whether or not they claim it or not. This is there's another new rule in the final regulations. There's always been a question on vacant property. So if we know you need to buy something new, what happens if you bought a building that's been vacant for 10 years? It's not new, but it hasn't been used in a long time. And there was a rule in the proposed regulations that said, well, under certain circumstances, you can treat vacant property as good property. The final regulations relaxed the standard, and they gave us a couple of different variations that said, one of them is if vacant property and it was vacant at least 1 year prior to its designation as being in an opportunity zone. So this would be vacant at least 1 year before December of 2017. Then you can treat that property, if you purchase it, you can treat it as original use property. If you don't satisfy that standard, then there's another standard in place that if it was vacant for an uninterrupted 3-year period after its designation as being in a NOZ zone, or in an opportunity zone. The definition of vacant is more than 80% of a building or land based on square footage not being used. So just something to think about. If you're looking at something that's an existing structure but it's vacant, there may be ways to plan into that and satisfy the original use requirement. So I see we had a question here. It says, it came in a couple 4 minutes ago. It says, does this work for livestock or agricultural purposes? I'm not sure if the question just relates generally to opportunity zones or to a specific point we were raising, but I think generally speaking, you can have a qualified business as long as it's a trade or business under the Internal Revenue Code. There are ways to potentially structure that to make it work for opportunity zone purposes. So livestock or agriculture, I think it could work. I don't know, Mac, if you have any follow-ups to that.
Haven't spent a lot of time on it. I think at first blush, the question has been around, you buy the land, it has some, might have some buildings or not on it, but can you substantially improve that, can you improve that property to the extent that's necessary to meet some of the requirements that I think you'll probably be talking about, that it can get a little tricky, I think, with farm and ranch property, but otherwise it would seem feasible to me.
Yeah, and that's a good point. And the other thing that this comes up, and we'll touch on it in a second, is to the extent it's land that maybe you're leasing. If it's farmland that you're leasing, there's a question of just land leasing or land rentals. Are those on its own, is that a good business for opportunity zone purposes? And we'll touch on that in a second. So the other way, continuing with that, so you can buy new property that satisfies the original use. There's also a way, though, if you have used tangible property, so this could be cars, trucks, other business property. You don't necessarily, of course, if you buy it new, that counts as original use. But there's also a way that used tangible property can satisfy the original use requirement for opportunity zone purposes. And the way that works is if the used tangible property, if it was never placed in service in an opportunity zone, then you can buy it, bring it into your opportunity zone, and as long as you're placing it into service there, it'll satisfy the original use. So the example people use, you could buy machinery, you could buy a truck, you could buy a car, you could buy other components, other tangible property components to a business. If those had been previously used outside of an opportunity zone, buy those used, bring them into an opportunity zone, you could potentially satisfy the original use requirement. But if it had been, and we'll cover this on the next slide, but if it had been previously used in an opportunity zone, you won't satisfy the original use requirement. Instead, you would have to satisfy the substantial improvement requirement. So the other, again, brought this up here, the original use requirement is one requirement you need to meet for having quote unquote good property. If you can't meet that because you're buying used property that's already been placed into service in an opportunity zone, there's a way to do that. You have to quote unquote substantially improve that. So first thing is, just like original use property, the first requirement is you need to purchase it after 12/31/17 from a quote unquote unrelated seller. The idea of substantial improvement is that what Congress wants you doing is putting capital into the zone, investing capital into the zone. And so the way that works for substantial improvement purposes is every dollar that's allocated to the cost of the property you purchased, you have to put an additional dollar of improvements into that property. Taxpayer friendly rule here, the portion of the purchase price that's allocated to land, you can't really improve land, so you can exclude that from the equation. So the simple example I have here is you purchase land in a building for $150,000. 50,000 of it is allocated to land, and 100,000 is allocated to a building. You'd need to put $100,000 of improvements into the building to have good property. Fortunately, you don't have to do that all at once or in the first year. You have 30 months to make those substantial improvements. And helpfully, I think, again, this was a rule people perhaps assumed in the proposed regulations, although I will say that no one knew for sure. It's one of these things you worry about late at night. But they clarified for us in the final regulations that you have 30 months to make your substantial improvements. And during that time, if you're satisfying all the other requirements, you're deemed to hold good property, even though you may not be fully operational yet, or even though you haven't completed your substantial improvements. If you're doing it in the 30-month period, you're deemed to hold it when you're filing your tax forms and your tax returns, that you can say, I had good property. So a taxpayer-friendly answer. We had a question here came in from the chat. It's, I own multiple rental properties by a university, and they want to develop. Could I start a new Oz fund and sell the properties to that fund? So we're going to get to that question in a second. This is probably one of the most common questions we've had since the beginning is, if you own property in an opportunity zone, can you sell it to a fund? The short answer is no. If you're going to own more than 20% of the fund, and potentially even less than 20% of the fund, there are issues there. But we're going to, I'm going to put that question on hold for a second. It's a very good question, but we have a couple of slides that will cover this exact topic. Also, substantial improvement, generally speaking, it's measured on an asset by asset basis. That would mean that if you bought 10 assets, you'd need to substantially improve each asset on its own. The proposed regulations from last year told us that you weren't allowed to aggregate, meaning that if you made, if you bought a couple $100 worth of assets, each asset you'd have to improve on its own, and you couldn't take, if you made more improvements to one asset, you couldn't put that towards the test for the other assets. Fortunately, the government backed away from that stringent standard and said, well, under certain circumstances, we'll let you aggregate for purposes of the substantial improvement rules. Helpful rule. So for real estate, for buildings, one of the rules says that if there's a single parcel of land, part of a single deed, then improvements you make to property on that single parcel of land, you can aggregate that. So if you bought 2 buildings or 2 homes on one parcel of land in a single deed, and you just made improvements to one but not the other, you could aggregate that for purposes of the substantial improvement rules. And as long as your total improvements made, equal the purchase price allocated to those buildings, then you could satisfy the substantial improvement rules. The second rule says if you can't satisfy the first rule, if you don't have a single deed, you have multiple parcels, you can treat them as a quote unquote eligible building group. We are always amused by all these new terms and these new acronyms that we now have to learn and get up to speed on, but in quote unquote eligible building group can be treated as single property, meaning you can aggregate them together for the substantial improvement test if you satisfy these three elements below, that there's a single entity that owns and operates, that they share some common business elements, back office functions, facilities, etc. And then they're operated in coordination and reliance upon one or more trades or businesses. So again, there's some element of relatedness there. Generally, it's a very taxpayer-friendly rule, and I think we've maybe mentioned it in the beginning, but the final regulations generally, I think they should be commended that the government was really trying to help taxpayers. All of the open questions or the things people worried about, the government tried to come up with rules that were workable. To say the government can't rewrite the statute, so they're forced to deal with the rules as they exist. But within that framework, they tried to be as responsive as possible to taxpayer concerns and really, truthfully, give taxpayer-friendly answers for the most part. A couple other examples we'll move. As always, we're running short on time here, but aggregation is also allowed. You can aggregate original use assets with used assets for purposes of substantial improvement test. Again, if these assets are used in part of the same trade or business, and there's some functional relationship between those new assets. So also there's an interesting example in the final regulations that kind of shows how that might work. And the example is a fund purchases a hotel business, and there's land and buildings, but there's also expenditures related to ancillary assets, linens, furniture, and so forth. And basically the linens, furniture, exercise equipment, these are the new assets they have to purchase. They all count as original use assets, and that they can be counted toward the substantial improvement test for purposes of the existing land and building. Again, a taxpayer-friendly rule. So we had a question here come up. In the case of condominiums, is the entire value considered improvement, or is some associated with the land? So generally speaking, if you bought existing condominiums, existing real estate, and you bought it post 12/31/17 and they're condominiums, the purchase price allocated to the units themselves, the building, that's the portion you have to substantially improve. The land, the price allocated to the land, you would not have to substantially improve. If I'm mischaracterizing your question, please respond, and I'll see if I can be more specific. Leases. So this is leasing works, and lessee improvements count as good property. A couple of requirements: the lease needs to be entered into after December 31st, 2017. 70% of the property needs to be used in an opportunity zone during 90% of the time. You need a market rate lease, and it's presumed to be under the final regulations. If there's unrelated parties, you're presumed to have a market rate lease. If there's related parties, there's some stiffer rules. For instance, if you have a related party leasing, you can't prepay. And if there's tangible property, non-real property, tangible property, you need to acquire other tangible property at least equal in value to the value of the leased property. So as I said, clarification in the final regulations, leasing between unrelated parties is presumed to be market rate. There's been some warnings issued by the IRS in regards to triple net leases. I don't think a triple net lease is not necessarily fatal for opportunity zone purposes, but I think the IRS also, though, has said that triple net leases on their own could be problematic. And the statement in the final regulations is just entering into a triple net lease with respect to real property doesn't necessarily constitute the active conduct of a trade or business. And I think what the IRS is getting at is triple net leases on their own could look like more of an investment activity rather than a trade or business activity. But there's a helpful example that seems to show, again, that just on its own, a triple net lease isn't fatal. And the example is a mixed use building where you have multiple tenants. one of the tenants is on a triple net lease, but there are other tenants not on a triple net lease and the owner has some active involvement in the property. The example says on the whole that qualifies as a good business. So I think just taking a step back, if you have a triple net lease, it's something to think about. If you're at all able to structure out of a triple net, so have landlord take on some additional risk, that may be another way to take this issue off the table. So back to the question I had a couple 10 minutes ago, can you sell property you own now to a fund? And does that somehow get around the problem of needing to purchase the property after 12/31/17? The answer is generally no. There's a related party rule that says if you own more than 20% of a fund, and then you also own more than 20% of the property, the fund's purchase of the property won't count. There was some warnings in that the IRS gave in the final regulations that even selling land to a fund and then rolling the gain into the fund could jeopardize the land as being good property. And the IRS seemed to say even if you own less than 20% of the fund. There's some confusion there, but potentially problematic. So what's the planning technique? The planning technique is if you're an existing landowner in an opportunity zone, potentially what you can do is lease property to the fund because there is no related party prohibition against leasing. So that's the planning opportunity, and that's for the most part our advice has been to clients with this issue is, can we structure a lease to make it work? Because you can own 100% of the land and you could functionally control the fund own 100% of the fund with related parties and not have an issue for lease purposes. Land, really quickly, you don't need original use for land. Land can't be originally used. Land's been around forever. And you can lease. Obviously, lease real property does qualify as an active business, but you just want to be aware of what the IRS calls land banking. And this goes back maybe to the farming question we had 10 minutes ago, but the leasing of raw land by itself could be viewed by the IRS as more of an investment activity, again, not an active trade or business, so that it may not produce a good business or a good asset for opportunity zone purposes. The example the IRS gave us is taxpayer purchased raw land and put a parking lot on it, didn't do a lot else to it, put a gate and maybe a small structure, and that a significant purpose for the acquisition was to hold the land and sell it at a profit 10 years later. What the IRS said is the land in that case is not qualified property. So you need to do something else besides just buying, in the parking lot example, what more could they have done? I don't know. Maybe if they had put a business structure of some sort on the lot, if they had constructed an office building, something more than just holding land and making minimal improvements to qualify for opportunity zone purposes. The working capital safe harbor, Mac mentioned this. This comes up in the context of if you have a fund and then the fund sets up a lower tier entity that is the QOZB partnership, you can treat, if you raise a bunch of capital and put it into your fund and then put it into this QOZB partnership, you can treat the capital is not a problem. So if you remember, part of Mac's presentation was cash on its own is potentially a bad asset. You can't just sit on cash. If it exceeds more than the de minimis amount of your assets, you have a bad asset. Problem is that if you're going to raise capital, let's say you're going to raise $10 million to build a hotel, it may take you 2-3 years to build that hotel. And there may be a period of time there where you're sitting on the cash, sitting on the capital you've raised, and you're not able to deploy it maybe until next year. Maybe you're paying your contractors as you go. So the IRS anticipated this and gave us something called a working capital safe harbor that says you can raise cash, you can put it into a QOZB partnership, and you can potentially avoid having that working capital be treated as a bad asset. If you have a written plan to use the capital, you have a written schedule that's consistent with ordinary startup of a business, and you use the working capital in a manner consistent with your schedule. And you can have up to 31 months to deploy your capital. And the final regulations tell us that you can potentially have more than 31 months even if you have multiple capital raises. The way I explain this to clients here, I think, is as long as you're following normal business practices, I think this is a very useful safe harbor. If your goal is just to sit on cash and vaguely have a plan to use it, but you don't really have any concrete plan to use it, and you just want to sit on your deferred cash for a couple of years, you'd worry a little more about trying to explain that ultimately if the IRS looked at it. This is what that basic structure looks like quickly. It seems silly in a way that this is the structure you would have to use, but welcome to tax reform. Great ideas, but in practice, it's difficult to carry it out in a simplified manner. But it shows that we have the fund above, so you have cash come in, you have the fund. The QOF puts gain into the QOZB, which is the lower tier partnership, and then the QOZB makes the investment. Why would you do this? Well, one, the QOZB can use the working capital safe harbor. QOF cannot. Two, as Mac pointed out, the QOZB has this relaxed 70% standard. QOF doesn't have that relaxed standard. QOF has the 90% standard. So this structure or variations of this structure have become the preferred structure as we go forward. And clients are always mystified. Why do I need to set up two different entities if the goal is just to purchase property in an opportunity zone? That's a great question, but maybe put that back to your congressperson on that. Inclusion events, just things to be careful about. If you want to be holding your investment for 10 years, as we mentioned in the beginning, there are certain things that can happen during that intervening 10-year period that could trigger your deferred gain in whole or in part, and could even potentially jeopardize your whole qualified investment. And these include, not surprisingly, if you sell a portion of all of your interest, if you take cash distributions out of a fund, leverage distributions even out of a fund can create issues. If you gift certain interests, or if you transfer interests, that can create issues. A couple of clarifications in the final regulations. First, death. If you die holding an interest in and of itself, that is not an inclusion event, but it produces income in respect of a decedent, meaning the deferred gains are picked up by the estate. So all things being equal, if you knew you were going to pass away, you may prefer a 1031 exchange or another deferral mechanism, because at least you could get stepped up. Here, you're going to pick up that deferred gain. Also, but maybe a helpful rule in final regulations, if unfortunately you do pick up, if some unfortunate event produces this gain from an inclusion event, you could potentially defer that gain by investing it into a new fund. That brings us to our third polling question. Do you already own property in a QOZ? Yes, real estate, yes, an operating business, or C, no. Interesting, and I'll turn it over to Mac here for take us home.
Okay, well, once you're in the opportunity fund for 10 years, then what happens? Well, this is potentially what I'd call the home run, what Adam called the juice of the opportunity zone incentives, that as the owner of the fund, you can sell your ownership interest, get a step up in basis to fair market value, and avoid the tax on the entire gain amount. And that's regardless whether it's capital gain or ordinary income. But I think, as we've learned over the years, this isn't always the preferred way of getting out of a business activity. Often buyers would rather purchase assets instead of ownership interests in a partnership or a corporation. And under the proposed regulations, if an opportunity fund that's a partnership or an S corporation sells its assets, only the capital gain allocated to owners from the sale of the QOZ business property can be excluded from tax. So income from sales of inventory, cash basis receivables, the depreciation recapture, for example, would still be subject to tax in the event of an asset sale. Also, the proposed regulations gave no asset sale relief at all to opportunity funds that were formed as regular corporations, or more troublesome, a more troublesome feature was even for sales of assets by a QOZ business. That's that second tier entity. Well, fortunately, the final regulations expand the asset sale exclusion to exclude all gains from the sale of property, other than gains from selling inventory. They still have carved that out. But regardless of whether it's the fund or the QOZ business that sells those assets. And this is a big change from the proposed regulations, and it should help, especially those funds that are looking to invest in several different opportunity zone businesses. A reminder that we've got on the slide, keep in mind that the original deferred gain, reduced by any basis step up, still needs to be recognized no later than December 31st, 2026, barring one of the exclusion events that Adam talked about. And it's taxed at the then current rate. So investors still need to plan and set aside cash to pay the potential 2026 tax liability. Quickly run through some miscellaneous, but in a couple of cases, important items as we wrap up the presentation here. Slide 42. There certainly were some surprises in the final regulations. A couple of the concerns are on this slide. This first one is one that Adam mentioned back on, I think it was slide 32. Just warn taxpayers that, yeah, we want to encourage people to take advantage of the tax incentives, and we want to encourage people to do transactions and provide economic opportunity in these low-income census tracts, but don't forget about things like step transaction and circular cash flow doctrines. And so the potential concern here was, as Adam described, third-party taxpayers, say Adam sells property at a gain to a fund, then he decides he kind of likes the project and decides to take his gain from that sale and put it back in the same fund. And when the dust clears, the substance looks very similar to what would have happened if he would have contributed the property to the fund in return for his ownership interest. And if looked at that way, the investment doesn't qualify for the opportunity zone incentives, and the property isn't good QOZ business property since it isn't acquired by purchase. So just need to be aware of that and take some care structuring transactions, I think. Second quirk that was also addressed in preamble comments suggests that improvements made to bad non-qualifying property are tainted and are not treated as a separate purchase of good QOZ property. The example on the slide may help. If the fund itself purchases property, say an old building for $20,000, excluding land, from a related party, so it's a bad asset, and then it makes $80,000 of improvements, presumably, and those improvements are done by an unrelated party, the entire $100,000 of property is treated as a bad non-qualifying property when the fund does its 90% or the QOZ business does its 70% asset test. Before the comment in the preamble, I certainly assumed that the $80,000 of improvements would have been good property. As Adam mentioned earlier, leasing the property rather than buying it typically is the best alternative, where the fund wants to use a non-qualifying asset in a project or an investor already owns property in a zone. That's really the moral of this story, and just to drive that home. Which regulations apply, the proposed or the final ones? Adam covered this at the front end. Basically, it'll be, for most people, it'll be 2021 before the final regulations are truly effective, but we've got a choice in the meantime. So for calendar year 2020, we can, or earlier years, we can choose to follow one or the other, and there's some question about what was really intended, but it appears that we need to follow one or the other in their entirety. We can't cherry pick provisions from each set. So this means we'll need to choose wisely. For example, if you want to use the netting approach for Section 1231 gains in the proposed regulations to get extra time to reinvest gain in a QOF, you won't necessarily be able to use a provision like the aggregation rules that Adam was talking about that are in the final regulations. So just have to take care with those decisions. State and local issues, our focus has been on federal opportunity zone incentives. View of the time, I won't go into detail on this, but it's critical. There are a few states, particularly California, that haven't adopted the rules. So before investing in a fund, be sure to look at applicable state law, and that's for your state of residence as well as where the zone is. But also investigate incentives that may be offered by state and local governments over and above tax benefits to encourage these developments. Forms and instructions, the key forms are listed on the slide, the 8996 and the 8997. If you haven't looked at them, you may want to and kind of get a feel for what you're in for from a reporting standpoint. And then the final regulations had some good news for corporations filing consolidated returns. I think the slide kind of summarizes the change. I think the main thing is we should see more interest among groups of corporations filing consolidated returns, particularly maybe some banking groups that may find that there's more benefit to doing the reinvestment of capital gains into a fund than maybe it appeared initially. And that would take us to the last polling question. Are you thinking of investing in a QOF that also offers other incentives? And perhaps combining with a low-income housing tax credit deal, or combining with a historic tax credit deal, or with Section 1202 qualified small business stock, know or didn't know we could combine tax incentives. And that's really the point of the question, is just to suggest that it would seem possible to combine these things. So if you're looking at doing one of the other projects, it may be worth taking a step back and looking, well, could we do it in a zone, and would that be something that would benefit a low-income community and help us out with some tax incentives?
All right, it looks like we are just about out of time here.
Yeah, we'll stick around. This is, if there's any other questions, we'll stick around. I know, sorry for going 2 minutes over. Please do leave if you need to get on with your day, but to the extent there's questions, we can stick around here for a few minutes and answer it if you want to post questions to the questions box. But otherwise, we really appreciate everyone spending the hour with us. And even if you don't stick around with the questions, if you later on have a question or are interested in talking about this more, please reach out to us or Joe Monty in Colorado, or I suppose even with your tax advisor. Thank you very much.
Awesome. Oh, we do have one question there.
So sin businesses qualify, a brewery or a distillery.
You know, Adam, I alluded to that on one of the prior slides. I just happen to have the statute here handy. Basically, what the sin business description is, any store, the principal business of which is the sale of alcoholic beverages for consumption off premises. So the question is, with the circumstances of a brewery or distillery or a winery, what is the principal business that's being carried on? And I think, as we talked about in the slide, if there's concern about that, then you should be able to operate that at the fund level rather than at the QOZ business level, because the fund itself doesn't have to be concerned about a sin business. Does that seem reasonable to you, Adam?
That makes sense to me. And again, if people wonder why could you do it at the fund level and not the business level, we agree doesn't seem to be any logic to it, but that's just the way the statute, or maybe Congress intended it, but it's just the way the statute is worded, and so that seems to be most people's conclusion when they look at it.
Yeah, thank you.
Stick around maybe for one more minute. No other questions, but no problem. John, thank you. That was a good question. Thank you.
Yep.
All right. Well, thank you all so much for attending. You do have their direct contact information on your screen, and thank you all so much. Everyone have a great weekend.